Hello and welcome to the Investor Master Series. My name is James Boyd. Alongside with me is Connie Hill. We call ourselves the two redheads, and we'll take care of you here today. For many of you, it might be a beginner, some of you intermediate, some of you advanced. Don't worry, we're all going to be fed here today and have a little fun. So we'll learn something, and we'll talk about markets and posture. We'll also talk about past examples that we need to address as we have option expiration on Friday. But we also talk about some examples from yesterday's discussion on trading with technical indicators. So just real quick as we get started, this Investor Master Series, what is it? Well, we cover everything, mainly stocks, technical analysis, fundamentals, options, right? We try to bring it all together. The only topics we don't bring up, ETFs. Connie teaches that Monday at 4 p.m. Eastern. Kevin Horner and I also teach ETFs on Friday at 9:30. We do not talk about futures and currency. That's Thursday. Michael Fairborn actually teaches that. So just real quick as we get going here, want to kind of just remind us when we talk about examples of options carry a high level of risk, not suitable for all investors. Also remember the information here is provided for general informational purposes only. This webcast discusses technical analysis. That's not the only way to look at stocks. Fundamental analysis we talk about tomorrow at 4 p.m. Eastern. So if you want to join us for that, join us, okay? And that way we actually talk about kind of looking for stocks that have some fundamental backing to it and drivers that also might drive those technical trends. It would make a lot of sense to look at both of that, by the way, and not just one. Also, remember that investing involves risk. And also, as we talk about examples, they are just that. And short options can be assigned at any time up to the expiration, regardless of the in-the-money amount. That's known as American-style options, not European. Now, today we'll talk about just kind of where the markets are. I had a question this morning, and it says, is this euphoric mania? Okay, that was funny. I had a good laugh on that. So we'll kind of talk about, is this really euphoria? Or kind of our investors maybe really more optimistic than we are? Or maybe do they have more money willing to invest and risk? Sometimes that can be the case. So we'll talk also about past examples that we need to address, talk about the expiration we have coming on Friday and the closing out of our positions. And then we're going to talk about some new examples. So first off, I want to bring up, the first chart I want to kind of bring up is the US dollar, okay? I'm imagining many of you, not all, okay? I know some of you are Canadians, some of you live over in Europe, some of you live wherever. And the US dollar, so if you are sitting in US dollars, this smashing to the upside of the US dollar has been quite helpful. You look at the euro relative to the euro dollar, the pound dollar, the dollar Canadian, and so on. Geez, maybe that Switzerland vacation, maybe that Europe vacation in euros, maybe becoming a little cheaper. So first off, I posted something talking about how some international investors are the most weighted to U.S. equities ever, okay? And if they're selling out of their currencies, then coming to the U.S. dollar, they need U.S. dollars to buy those assets here in our markets, okay? It's typically how it works that I know of. Now, if we take a look at this, we also see that if I took a look at, let's say, the euro dollar, we have crashed down to 106 per the U.S. dollar, okay? So what you're going to see is they would get, by the way, if this actually goes lower than, let's say, 106, we're taking out the year low. So the dollar strength continuing right now, could that continue? Now, when we take a look at also just real quick, the SPX, remember, this has been in the last week or so, it's been we could say the word violent, okay? We crashed to the upside. And normally when we talk about bull flags, right, we're talking about something where we go up 5 to 7 days. Maybe that's the pull, okay, 5 to 7 days. And then maybe after those 5 to 7 days, you kind of get a flag. So this is kind of not unusual that you get a little pause, a pullback, right? The breakout area really being 58.50. If investors bought in this magnitude, they're not thinking just what it could do in the next week. They're probably thinking what it could do in the next couple quarters, the next half year, the next year, and so on. They try to get ahead of what they think is coming, okay? And that could actually be higher GDP, higher consumer confidence, lower potential interest rates, higher consumer confidence, decent job numbers, and so on. Okay. Now, if we go back and look at, let's say, the Russell 2000, down 22 today, or about down 1%, but still a massive move just in the last couple of days to kind of give us an idea. Okay. Even if we look, so in the last 8 trading days, it's up 9.5%. We've had year-like returns in 8 days, 8 trading days. Okay. And no one's mad if they were invested in it. Okay. The people that are mad about it, they probably weren't in or got in late. Okay. What they feel is late. Now, when you go back and look at the daily chart, that is still showing strength there. NASDAQ, the one that's kind of very softly going down. We're going to talk about NASDAQ here today, a couple of stocks in there. NASDAQ only down 0.1%, okay? And the Dow Jones down 136. Now, again, whenever we kind of talk about different indices or sectors or stocks, I think it's helpful to look at the percentage. We're down 0.3%, so just kind of like a very small down day, okay? And just because it's a red candle doesn't mean it's bearish. Remember, same idea as the SPX, shot up a lot, so likely going to see a little consolidation here. Where is that higher low? Now, if I were to ask you, what sectors are you looking at, you personally, what would you say? Okay, now I asked this question before. What sectors are you looking at? Okay, now Thea actually says RUT and NASDAQ. Okay, fine. Okay, that's the indexes. Okay, and Russell, we can understand that. NASDAQ, Thea, I would also say has been quite strong. Now, we could honestly say that all the indexes look bullish, and I think we could agree with that, okay? Now, any sectors that you're looking at, I just kind of want to see something to see if anyone is bringing up any of the sectors, okay, that we saw this morning. So first off, financials, okay? So let's go to financials for just a moment, okay? We will talk about one of those stocks again in that area. When you look at financials, so when you kind of think about financials, number one, are people willing to risk, if willing to borrow? If they're willing to borrow, they probably have a job. If they're willing to borrow, they probably actually feel more confident about their where they stand financially, or maybe they need to. Okay, could be that too. But it's also from the bank's perspective. If people have jobs, they're less likely to default. Okay, on those loans. So it's kind of a twofold reason why the financials could be going up. But it's also the financials are the oil to the economic engine of the economy. Okay, so they think the economy is going to be pretty strong. The financials fuel that growth with liquidity of capital. Now, when you look at the IXE, we said this earlier this week. We said crude oil down near the lows, but the energy sector, doink, to the upside. Name 2 sectors that actually drive that sector. The answer would be ExxonMobil, which is in the paper money account in the IRA, and Chevron. Now, if you added, for example, ConocoPhillips, 3 stocks represent about 45% of that space. 3 stocks, Chevron, Exxon, and ConocoPhillips. So a lot of people look at a lot of different things. Do not forget kind of what is driving that space. Now, the other thing is I want to kind of make mention is when we talk about the communication sector, okay? We saw, for example, the communication sector again make a brand new high, and that sector is really bolstered by Meta, which is about 19%, Google, which is about 20% of that sector, which we could pull up, and then we got Netflix at 6.4%, and T-Mobile at 4.75%. 5 of those stocks, Google and Google L, okay, Meta, Netflix, and T-Mobile. 5 stocks represent 50% of the sector. It's unequally weighted, okay? Now, if we take a look at this, stocks in that area like, let's say, T-Mobile, which is in the paper money account, still very bullish. You look at Netflix, still very bullish. Have 30 shares in the paper money account. We'll talk about that. Google here still looks quite bullish. And on the right-hand side, tell me what type of price pattern do we see on the right-hand side? What do we see? What do we see on the right-hand side on Google? What do you notice? Yeah, maybe like a little ascending triangle, maybe trying to carve out maybe some horizontal resistance. Still overall looking quite strong though. The other one that got a little poke this morning is Meta. Meta was up right around 600 bucks, faded back some, but overall retested 600 again. We're going to talk about Google. We'll talk about Netflix. We'll also talk about Meta as well. Okay. So do not forget the communication sector, energy, and financials. Okay. Now, what I want to do is I want to go back to some just real quick. We talk about the markets, we talk about the sectors. Now let's move towards some stocks that we need to look at. Okay. Now, and when I say stocks, we'll say stocks and option trades. Now, if you follow us in our classes, you know that we're not just teaching strategy and market posture, things like that. We talk about teaching market posture with strategy and then picking stocks to show examples, not recommendations. But let's look at a couple examples right in the IRA account. Now, if you look at CRM, and I'm just going to go look in this section here, some of these will be stocks like Chevron and Love. But if we see that this first row says 0, you don't have shares, okay? We have an option. Now, CRM, we had talked about that a number of times, and we did really on the 29th, an example where we bought a long call. We know it's a long call because it says +1. We bought one contract of that 290 call. Now, why do people like long calls? Well, you like the long calls because there's unlimited upside. Hallelujah. Okay. Well, so we paid 20 bucks for that. 20 bucks being really about $2,000. Ain't cheap. Now, we also sold the put. And when you sell the put, you're trying to collect the premium to help offset what you paid for some of that long call. So the debit is you paid 20-ish, you collected 11, and maybe we got something right around $9 or $900 is what we paid. Now that $900 investment, bang, went to about a $4,700 gain. What did that look like on the chart here? Well, let's pull it up. Well, if we look at CRM on the 29th, where was that invested? It was invested about right there. Okay. So on that date right there, it actually was a little shorter term breakout, went down for 1 day, went down for 2 day, bullish engulfed, and then said, spank you very much. Now, I want to kind of go back to this example. Tell me how to manage this position here. How do we manage the position? Well, it doesn't matter if you sold the call or you did a short call or short put. Doesn't matter. You get a set premium up front. You're trying to grab a certain percentage of that. Now, this is very atypical. It's not normal, right? Where with 38 days remaining, you have 85% of the premium. How on earth is that possible? Well, the only way that's possible, you get that type of percentage of that premium, is the stock exploded to the upside. And it did. Again, like a grand slam. Now, some investors might say, I ain't giving it back. Okay, now say that out loud. I ain't giving it back. Okay? Now, what we're going to do is we're going to right-click on that line, create closing order, buy. So we sold it initially. Okay, so we're -1. To get back to 0, we need to buy it. Okay? And what we're trying to do is stuff that. I feel like we need the envelope again. Okay, let's go back, and some of you like that example. Okay, so what we want to kind of do is talk about gains and losses. Okay, so we're going to kind of go back to the envelope and kind of talk about some potential gains. Okay, so $945, we're going to try to take that. We don't know if that's where it's going to get filled, and you got to remember is we're paying a commission. Okay, so we're willing to give back $180, add 65 cents. And what you're going to notice is we're trying to make the difference. Now, if I click on this, we can now look at the position and say, did it fill? And the answer is when I go back to the CRM, okay, that CRM position did fill. Where did it fill? It filled at $1.73. Okay, we said the most we were willing to buy it back for was 180. It did fill for a little bit less. Now, the other thing is I'm going to also talk about profit taking on this. Why? How many of you lately have been kind of thinking about Bollinger Bands? Okay. Now this chart, now we are not at the Apple headquarters in the back with the different rainbow colors. Okay. But remember, this is our 10-period moving average line. And this is 3% above the 10-day moving average. That's 5% above the 10-day moving average. This, for example, is 7% above the 10-day moving average. You could think of this like Bollinger Bands. Think of this as deviation away from the mean. And the higher up we go, the greater statistical likelihoods that the price reverts back down to the mean or the average. Now, if you realize, if you put a standard deviation of 2 or 3 or 4 or 5, you might say the odds of this holding here are very, very low. Now, you could also think, well, James, how likely is it that you go from a $20 investment to $58 and make that type of money in a short period of time? We also might say that's statistically unlikely. And when people realize that it's statistically unlikely, they might be more apt to do what? They might be more apt to do what? Take the profit. Now, could the investor sell that call? They're going to try to, with 38 days remaining. We're going to right-click on that, create closing order, sell. We're going to try to sell it for 58. Now, here's the deal. Be very careful in being too fast. The mid is 58.55. You got to remember something. When we go so deep in the money, the bid-ask spreads widen out. Those become more liquid. And so getting a fill can become a little harder if it goes too deep in the money, usually with a delta greater than 80-ish, especially 90. The bid-ask spread widen out, showing that those are not traded as much. If they're not traded as much, harder to get a fill. Confirm and send, note the commission, send the order. So the first item of business here is kind of taking something that exploded, okay, bought back the short put, trying to sell. Now, assume nothing. You verify. Oh, I put my order in. It should have filled. Well, it hasn't filled. And we're going to give this about 2 minutes. If it doesn't fill in the first 2 minutes, we're going to go back, and sometimes just a nickel or a dime could be the difference. This is not a time to pat yourself on the back and tell your friend how smart you are, even though that is fun, okay? But we want to make sure, does that fill? Now, just so we can try to have a better chance to get filled, I'm going to undershoot the mid price, and I put it at 58. So I undercut it, and I'm going to try to see if we can't get filled. Now, I also know it canceled it, but it has not filled yet. So we will watch that. But that price is sinking like sinking a little bit. Want to make sure we can try to get out and capture that gain. Now, by the way, could the gain have been bigger? The answer is yes. Now, let's kind of take a look at one that we need to address, okay? Micron. Now, what's the problem with Micron? Well, Micron, we have one short put at the 110, right? And so what you're going to notice is it sold for $5.90 and the option price went up. So this is the opposite. The stock did not explode higher. It went down. The stock went down. And if the stock goes down, the put values increase. And if the put values increase after you already sold the put, you have a loss. So on this one, the stock today kind of not helping us out. Stock is down 555. Now let's go back and kind of make the decision. Is Micron really breaking support, or is it just down? Now, I need your help here, okay? Would you say that Micron is breaking the support? Now this, you might be thinking, well, why are you asking the question? Because our comment is we don't want to, in our example, have an obligation to buy shares of stock if it's breaking support. So James, when you look at the support, how far are you going back? Minimum 2 to 3 weeks. If we went back 2 to 3 weeks and said, are we breaking support? We cannot say that it's breaking support. So that's going to make the decision of whether we buy the option back or not. In this case, we're not going to buy the option back, but the stock, for example, is below the short strike. What does that mean? At any time, they could actually assign us the shares of stock. What does that mean in English? That means we're a buyer of the shares, 100 of them, at 110. This long put pretty much is worthless. That's just downside protection and a buying power reduction. But we are highly likely, okay, if we were 3 days to expiration, there would be a really, really good chance that we're going to be the buyer of the shares at the strike price. So remember, whenever you do this strategy, you have to think to yourself, do you want those shares? Okay? Do you want them? So you have to plan on, when you do the number of contracts, could you afford and are you willing to buy the shares. Micron, the short option, has 38 days remaining. Fine. Stock has not broken support, but it's under pressure. Now, I want to speak to this last one just real quick, which is Tesla. And Tesla also, with 38 days remaining, is at 64%. Let's go back to the envelope, okay? So some of you said, we talked about this last week, if we get 50% in the first 10 days of doing the trade, okay, if we're talking about an option, 20, 50 days expiration, we get 50% in the first 10 days, that's like solid return. If we get 65% with 20 days remaining, that's like a solid return. If we get 80% ever, that's like a solid return. The only way you get 100 is you go all the way to expiration. You get close to 100, but you don't get 100 typically until you go all the way to expiration. On this example, when was this placed? It was placed on the 7th. 5 days ago, we did one contract, and what we're going to do is we're going to right-click on that, okay, create closing order, buy that back. So this might be confusing for some. You're selling, you went short to begin with, which if you do a short put is a bullish trade. And to get out, we're exiting, we're buying it back for a debit. We got in for a credit because we went short, and we're buying it back for a debit. That debit being 324, confirm and send, and note the commission there, send that order. Now, I'm just going to visually speak to a couple, and I'm not going to go through each one of them, but I'll just highlight a couple that probably need to be taken down. The other ones that kind of need to be taken down, Tesla's at 99%. You get Goldman Sachs at 90%. We'll take that down. We won't go over it. Simon Property Group at 96%. We already talked about Micron, down. 98% on Crowd, 99% on Amazon. So those are all ones, if we had more time, we just close them down, okay? Apple being a pig here, nothing wrong with pigs, love pigs, but overall, just 40%. I mean, barely surviving, okay? Not a whole lot there. Now, I want to kind of talk about some new examples that might be standing out. I want to go back just real quick. Now, CRM did fill, okay? So confirmed, okay? Monitor. We look at the filled orders. Did CRM fill? Do not call. So this is where people kind of get prideful. They get so stoked, they actually forget to be disciplined. Okay, forgot. And there's no position there. Check. Zeros. And we see that it filled. Okay, so now we can actually say, okay, what did we learn? And did we make anything? Okay, fine. Now we could actually have that discussion. What I want to do for a second is I want to go back just real quick to NVIDIA. And if we look at NVIDIA, I want to go back to like an earnings example. Now, earnings on this is on the 20th. Okay, it's on the 20th. Now, if I ask you the question, like, what type of price pattern do you see on this? What do you notice? So if we kind of said price pattern, this is the old breakout area. We ran up, we pulled back, and then we're sitting right here. Now, I posted something earlier this morning where I was absolutely like blown away, okay? So if we take a look at something, NVIDIA, okay? So if we go back to NVIDIA for just a sec, something that I said on NVIDIA, yeah, there it is. So NVIDIA's total value, market cap-wise, $3.6 trillion. Japan's Nikkei 225 index, which itself is valued at $4.65 trillion. Gosh, that kind of puts it in perspective, doesn't it? So pretty amazing that one stock, almost the capitalization of the Nikkei, the Japanese stock market. Now, if we look at this, we got earnings coming up. What we're going to try to do is more of a higher probability type trade. What does that even mean? So when I say a higher probability type trade, we're going to try to go down and sell something. Now, if we go to the 20th of December, now, by the way, you see that white stuff behind me? Follow my finger all the way back. That white stuff is snow. If you want some free snow, you can come get it for free. I'll even help shovel it, okay? Now, so just know that is coming. Now, if we look at this, we're going to do something more highly probable, okay? It doesn't mean it's 100% that it's going to work. It just means we're going to try to stack the odds more in our favor that we could be right. But we're still risking something. Important point. Now, normally in our trades, we try to do something with a delta between 30 and 40. But if we said, you know what, James, I'm going to try to use this higher implied volatility. And with the higher implied volatility, we could try to sell something lower and still get some premium. Now, what I'm going to do in this case is I'm going to go take a look at, let's say, the open interest, 4,500 there on the open interest. And when we also take a look at, let's say, what's the volume on this? What type of volume do we have? 75 contracts traded so far. If we wanted to try to go to where there's more volume, we might even go to, let's say, the 130. Now, what I want to do is I want to bring up something that could be helpful. When we kind of look at what's called return on risk, it's 2.35%. So think of that taking the option premium divided by the current stock price, and you're going to get pretty close to right around that 2.3-ish. In our trade example, we're going to sell 2 of these, okay? Sell 2, okay? And we're pressing 2. And what I'm going to do is I'm going to sell 2. Now, if we sell 2, what do we have the obligation of? We have the obligation to buy $26,000 worth of stock. Why did I say we're pressing that? Because that could be like right at the threshold, maybe slightly over what we normally will allocate to a position. But why do you say that this is a position? Because we're accounting that this could become shares of potential stock, not just expiration, prior to as well. Now, what I'm going to do is we're going to sell 2. And now what I'm going to do is I'm going to come to the mid price, 294. Now, if we do not buy, okay, a downside put, what happens? It's going to tie up more capital. It's going to tie up $25,000 worth of stock, $25,000 worth of capital. If we said, look, I don't want to do that, and I want to have some downside protection, but I'm going to make it low on purpose. Why does someone make it low? Well, they're trying to actually keep a higher credit, okay? Now, what I'm going to do in this case, if we went all the way down, and I'm going to go way down, something like 100, okay? And if we did this and said, look, we're going to buy the 100, the spread is $30 wide, okay? And if we look at this, by widening out that spread, we're trying to still hold a certain amount of credit, okay? Now, if I do that, and go confirm and send after I change this back to 2 contracts, the amount of capital we're tying up is not $25,000 given the 2 contracts, it's $5,400. There's a defined max loss given, and there's actually a theoretical profit as well. How do you make the 510? Well, if we're talking about getting all of it, closing above the strike price at expiration. Now, notice in this example, we're not saying a comment like, well, I don't like earnings. There's ways we could try to build the trade to be more successful. How? Well, change the strike price you're picking, okay? If you're trying to actually have a greater chance of this trade being right, the investor might sell a lower delta. In this case, the delta is stating that currently the probability of the stock being below the strike price by a penny, 19%. 81% chance it could be above. Everything sums to 100, right? So we're talking about delta being a proxy for probability. Delta also being the change in the option price given a $1 change in the stock price. It's the other way to think of it too. Now, trade number 2 I'm going to go back to is I'm going to go back to Netflix for just a moment, okay? Now, I need some help, okay? So one of the things I want to make sure, we said last week, when you come to any classes I teach, we're going to have a tennis lesson. If you've ever played tennis or if you play pickleball, you know that it's just not me hitting. I'm going to hit it to you, and then you hit it back to me. Now, we have shares of stock. And if this was your example, how would you raise that stop? Now, don't worry. We're going to do a new example on this, okay? But just while we're here, I'm going to kind of just touch base on this, okay? So if I were to, let's say, look at this, we kind of have like an unusual situation. The 5-day low, 1, 2, 3, 4, 5. The last 5 days, the low over the last 5 days is 757. So even if we said, look, we're going to raise up our stop to like the 5-day low, that is still allowing $60 give back of potential gains. Now, what's the position? Answer. If we look at the shares that we have, 30 shares of stock, purchased at 7.15 down at the bottom, it's up 28.95. Now, how many of you have ever said, or you know someone who's ever said, I was doing really good? What's the next word? What's the next word? I was doing really good until what? Until it pulled back. So when we have kind of some of these explosive moves, how would we know that they're more explosive? Well, when we go back to this chart, and let me share it with you, okay? Yeah, so some of you knew that was wrong, okay? I hate that word until. Do not say the word until, okay? I don't want to hear that. Now, so we know that, for example, if you start getting outside, now remember the yellow line, that's 3% above the 10-period moving average. That's 5% above the 10-day moving average, the red line. That's 7%. So the risk becomes, what's the statistical chances that we can keep holding there? Now, with that in mind, what we're going to do is we're going to raise up the stop like right underneath today's low. Why? Well, because if we don't have like a target on this, we're going to try to, for example, swap going from a stock position and say the word harvesting that gain, or at least a greater chance to get a chunk of it. Now, when I say that, does a stop guarantee that we're locking in profit? Those are bad words. Don't ever say that. Stop does not lock in a profit. It's a trigger to sell the shares, which you don't know where the fill is going to be. So we're going to kind of plan that this little rally we have, we're going to try to capture. Now, remember, with the stock, the delta is 1. Meaning, if the stock goes up $1, the gain is $1. Okay? Which is awesome if it goes up. Not as awesome if it goes down. So what we're going to do is we're going to kind of play a little swap, selling the shares into some strength, and then doing something where we might be better suited to handle some consolidation, but try to get some time decay. Not decay, decay. Now, we go back to the trade tab. So we moved up the stop underneath today's low. Where is that stop? Answer, 802.22. So we're only going to give back about potentially $9, which is about 30 shares, $270. We're willing to give back about 10% of that, but old daddy or mama wants to try to hold on to a good chunk of that gain. So they don't say the word until it pull back. Now, how are we kind of gauging this? Well, the higher you go above that yellow line, or you get deeper into the red line, or you get deeper into the white line, some investors might say, James, I'm going to sell into that strength. Here's what you need to learn. You don't sell into the strength. Somebody else will. You ever feel like someone took your gains and put it in their account and then left you with the crumbs? You don't have to do that. You could play the probability. You could bring this up like how we have it here. You could bring up the moving average envelopes as well. Okay? Bollinger Bands, it's all very similar. Okay? So when we get outside these bands, okay, if you will, and the deeper we go up above it, the greater the chances that we have that it could consolidate and or pull back. And some investors might consider choking stops and or selling into the strength. Now, what we're going to do on this trade, we're going to go to Netflix. We're going to go down to, for example, the strike. And again, we're going to be a little bit more cautionary, okay? We're going to go down to about, let's say, in this case, probably lower delta, okay? We're going to go something about, okay? Now, notice we would normally do a delta of 30 to 40. But if we think there might be some consolidation, we're going to try to sell a little bit lower. The delta that we're looking at and strike is 770. We're going to right-click on that, 795, right-click, sell vertical, okay? Now, what this really is we're trying to really do a $10 wide spread, okay? That if we did a $5 wide spread, you'd probably have twice as number of contracts if you can risk that much. If we did a $10 wide spread, we're trying to get a bigger credit and not trying to do as many contracts. You do more contracts, there's more commission. Now, what is this trade? Well, we're selling. We're talking about a short put spread. We're selling the higher strike, want the stock to stay above that strike, and the strike below us is the downside protection. That what we see in this case is we have a $1.92 credit, okay? Now, in this case, what I want us to notice is, okay, when we look at the break even, we really actually have a 770, 760. There's the credit. This is the break even. Now, this is what stock investors need to understand. If someone buys a stock, what's the break even? Assuming there's no dividend or anything like that, the break even is what you paid for it. Here, the break even is almost what's like $45 lower, $39 lower. Check my math. Let's see, 811. Okay, 811 less 768, $43 lower. Okay, so that the stock is at 810. The break even is $43 lower. So now, if the stock stays above 770, we try to grab and get to keep the $192. Okay, if the stock closes above the strike price, we should have near that maximum gain and or maximum gain. Now, the commission being $1.30. How much money does it cost to get into this position in an IRA account? Answer, $808. Okay, so we're going to send that order. So trade number 2 is on Netflix. Trade number 1, if we go back and take a look at this so we can all follow along. So what was trade number 1 we did? Well, we did NVIDIA. We really did like a cash secured put. Trade number 2 that we're doing is Netflix. And Netflix, so you can follow along, is we're selling the 770 and also buying the 760. Just to kind of confirm, the stop, I've moved right near the intraday low. And that stop is right at 802.22. Why did you choke the stop so much? Choke the stop because we're kind of getting away further and further away from that 10-period moving average, which means there's a higher statistical chance that we revert, we kind of pull back and allow the moving average to catch up to us. We're not getting out of the ticker. We're just changing the strategy. Okay? Now, Art says, crumbs is what I'm living with. Well, brother, why do you think we're talking about the bread loaf here? Okay? So here's the thing. Sometimes what happens is, like if you play the golf, right? We know there's not just one club, there's one strategy. Sometimes it might make more sense based upon what you think is going to happen to change or consider changing the strategy. Now, if I went back to another stock that we're going to kind of keep an eye on, Zscaler. That was one that we actually saw a pretty big pop on, and we're going to look at doing this. Now, yesterday we talked about in the class called Trading with Technical Indicators, we talked about channels. Does anybody remember that discussion? Okay. Now, on that discussion, we talked about that was one of the 10 kind of ways the investor might be looking for. Let me take that 5-day low off. And they might be looking kind of for some repeated setups of that pattern. Now, you got an earnings upcoming on Zscaler. That stock has kind of been in a basing pattern. Now, one of the investors said, well, how do we know it's going to go up? Well, we don't know. Okay. We're going to try to go back to this just real quick, and I'm going to kind of speed up a little bit and kind of talk about some more examples. We're going to sell the 190 strike. Why did your eyes go to that? Well, my eyes went to that because that's right around the 30-ish delta. Okay. Selling, that is. That's also the strike that actually has the 797 contracts on the open interest. Bid-ask spread here being 20 cents wide. We're going to, now for those of you who do not do $10 wide strikes, we're going to sell, okay, then 190, thinking the stock can stay above, buy the 185 strike below. Now, $5 wide strike, $1.45 credit, okay? And if we take a look at this, this is the potential maximum gain and the potential maximum loss. On a calculator, if we take $145, okay, potential maximum gain, divide by 355, it gives us the ROR. Now that ROR is at 40%. Why does it seem a little higher? You got earnings coming up, right? that implied volatility is higher given the earnings coming up. Plus, it has 38 days left, so it's kind of farther out in time. So it's pushing up that ROR. ROR standing for return on risk. Note the commission. Trade number 3 here, Zscaler, send. Now, in our classes, we do stocks. We do a lot of cash secured puts. Why do you do a lot of cash secured puts? Well, because cash secured puts could be an income strategy, but also a stock buying strategy. Cash secured puts, whatever strike you sell, that's where you're trying to buy the stock. Okay? So there's, think of cash secured puts really as option strategies that could morph into shares, which maybe you want. Now, the other one I want to kind of keep an eye on is Meta. Now, you got to remember something. Meta, for example, is number 1 in the communication sector. If we see the communication sector continue to go up. Now, remember, what are the stocks in the communication sector? Meta, Google, what's the other one? Okay, T-Mobile, and I'm missing one of them. What's the other one in there? Netflix. Okay, so keep an eye on those 5. Now, if we said, well, I want to do a trade, but I want to see this rally back up, what I'm going to do is I'm going to right-click on the chart. We're going to go down to create an alert. What is the alert in order to get in? It's not, okay? It's just like an alarm clock. We're going to kind of put an alert and say, look, if this rallies back up, and it's just kind of an idea, okay, 594, we might say, hey, look, if we get to this price or higher, let us know. Give us a pop-up menu right on the platform. Send us a text, send us an email, whatever. And this is just going to kind of let us know that this might be in a continuation pattern. When you look at the weekly chart, it is kind of still setting up that flag, and it kind of has that little run up, pull back, and rally. You might think, we don't share that thought, if someone did think this, someone might say, oh yeah, rally up and fade back, it's showing signs of weakness. That's not necessarily true, okay? But sometimes you just have to get it to go up and test it again. The resistance is like a wall. The more times you hammer at it and hammer at it and hammer at it, a lot of times the greater the chances that wall could crumble down, okay? And you might say it's just reconfirming resistance. Now, I also want to kind of go back to, for example, last Thursday, we talked about Costco. And after we talked about that on Costco, the very next day, that stock went up, if you were watching, $50, okay? Now, some of you might have thought that Thursday discussion was kind of funny, and it kind of was, okay? Now, the stock has ran up, and it's pulled back. Now, on our last trade example, where has it pulled back to? Where's it pulled back to? Well, a lot of times we can kind of pull back to the middle of these large candles. Technicians call that support level area number 1. I think of this kind of being the open of that large green candle, kind of maybe potential support area number 2. Okay? Now, how many of you have ever seen a stock go up to go down 1 or 2 days or 3 and then shoot back to the upside? And you say a comment like, man, I missed the breakout. I saw it rally. Then you see it go down for 1, 2, 3 days, and then it bounces, and you missed it really twice. Now, if we're looking for a whole day, this is not it so far, okay? What we're going to try to do is we're going to try to do a short put vertical on this, on the red candle. Now, why would someone do that? Well, if someone's trying to do a short put vertical on the red candle, they're trying to get it when the price is down and maybe when the volatility is up a little bit. If they actually wait for the whole day, the price goes up and the premiums might not be as rich, okay? And then, by the way, if the premiums aren't as high, the break even's higher, okay? So what we're going to do is going to go back to the trade tab on Costco, okay? Now, let me kind of just say this in closing here. Here's the trend in Costco. Are you surprised? Okay, leave it at that. Now, send. Now, what I'm going to do, after I said that, 2 days later, my wife goes to Costco. Yeah, I won't tell you what happened. Okay, it was just brutal. Okay, now, if we, no, I'm not going back. Okay, now, if we take a look at this, what we're going to do is we're going to go down to that. I'm going to look and see which one has the most open interest. If we look at this one, got a 50-cent bid-ask spread. This one being about 45-ish. The closest thing we could really get on this is probably right about that 900 or so, or the 895. We're going to right-click, sell, and then what we're going to do in closing here is we're going to do that 890, okay? So today we did 4 trade examples, okay? We did NVIDIA, we did Netflix, we put the alert on Meta, and then we also, for example, did the trade on Zscaler, and also are doing a trade on Costco in closing. Now, in our classes, I want you to follow along in paper money. They're not recommendations. How do you learn? You listen, you watch, and you practice trade. Feel free to practice these alongside us in your paper money account, not recommendations. I said that twice. And practice, okay? Do you understand the price movement? Do you understand how the trade is working or not? I'm going to send that order. Send, okay? Now, I'm out of my time here today. Remember, if we were looking forward and said, what do we think the market is likely going to do? It would be probably appropriate to kind of get some consolidation, some higher lows. That does not mean all stocks are flat, though, okay? Now, I want us to also keep an eye on energy stocks. We talked about the top 2 in those areas as far as the stocks that matter more. We also want to keep an eye on financials, keep an eye on Berkshire Hathaway as an example, and also keep an eye on some of these communication stocks as well. Adobe also looking quite strong as well. Some investors might keep an eye. With that said, we also have Barbara Armstrong coming up next. Thank you, Connie, for answering those questions in chat. If you have not subscribed to the Trader Talk channel, do so. And I also believe in the chat there was a survey link. If you could click on that and fill out those quick 2 questions, that would be appreciated. This has been the class on the Investor Master Series using stocks and options. And with that said, remember that all investing involves risk. Stay tuned for Barbara coming up next. Take care. Bye-bye.